So hello everybody, welcome to our Energies Chat. My name is Heitor Paiva and I am the analyst here at HEDGEpoint Global Markets. And today we'll be talking about how fundamentals and risk management are connected, especially in the energy market. To do that, we have Jonathan Kornafel with us, who is our head of energy, and he's based in New York. What about it, Jonathan?
Well, I think it's a very interesting topic right now and a very interesting time. I think, Heitor, what we're seeing right now is really the entire concept of risk management being re-examined, and not just really in the energy value chain, but across all industries globally around the world right now. It's a very interesting time, very scary time to be alive, but also a very interesting time to be alive. And, you know, we're having conversations right now with CFOs, and those conversations are revolving not just around the normal topics about fuel purchasing or selling or storage, those sorts of ideas. Where's the energy market going to go in the near term or the long term? We're talking about a myriad of topics that either were theoretical for the past couple decades or really weren't even brought up. I think a good example of that is inflation. There's a lot of concern around inflation, and something that we really haven't seen in a lot of people's lifetimes. The idea that inflation is really going to have an impact on our lives going forward. And this is something relatively new. I think you're seeing this sort of in the bond markets with a rush to sort of bond issuance by a lot of companies. I think CFOs, one of the things they're seeing really is they're seeing rising wage bills. They're seeing the soaring cost of shipping right now and shortages of raw materials. So this is sort of impacting this whole paradigm shift that we're seeing in risk management right now. If you want to take a closer look, I guess, at the energy sector and maybe the consumer side, I mean, look at sort of airlines. Airlines, the tough time that they're going through right now, still about 16% of their budget, of their expenditure is spent on fuel costs. In the shipping world, if anywhere from 5 to 15% of freight costs is fuel. So these are enormous costs that you have to, even before COVID, obviously, and after, you have to make sure that these are not, there's no overexposure to these costs. And every company, anywhere up and down along the value chain in the energy world, has a different idea of the exposure that they want, of the exposure they're comfortable with, whether that's short-term, medium, or long-term, and how they can address the market. And everybody has a different balance sheet and different finances. And that is what we do. We work very closely with our customers to understand their specific business over not just now, but over the very long term. And then we help them shape a hedging program and a risk management program that really addresses all of those issues holistically.
I think that honestly, something that is obviously must be a topic of our conversation now is the pandemic. Like, even though there had already been some talks on the possibility of a pandemic to appear, like the impact in the energy market was pretty much shocking. Like in some countries, the product demand was sent to levels below the ones seen in last seen in the financial crisis, and also in the United States, refineries really the crude oil inputs by refineries really fell. Like, so I think that a lot of changes happened, and hopefully as the world vaccinates more, do you think that we may see any structural shift in demand, or are things really going to be back to what was before the pandemic?
I think that's interesting. You know, we've already seen a structural, maybe a short to medium term shift in demand, and I think it's gone on a lot longer than people were expecting. So when you talk about COVID, basically everything sort of comes back to supply and demand. COVID obviously has the biggest impact on the demand side of the equation. So we're seeing rising levels of vaccinations around the world, but there's still places where the Delta variant has hit very hard, particularly in Asia right now. So that's where a lot of the increases in demand, the marginal demand, comes from year on year. A lot of it comes from Asia, especially China. So, whether we see a winter spike in cases, I think we're starting to see Delta maybe back off a little bit, but in case there's always more versions of COVID coming out, unfortunately, and it's very scary. So if we have another sort of winter spike and another lockdown, that's really going to hit demand. I think we're seeing oil prices have rallied a little bit lately. That's based on the expectation of what everybody came into this quarter and this part of the year with, is that there would be increases in demand. Maybe COVID would start going away. People would start living their lives. Business travel would go on. People would travel for leisure. I think there's been a bit of a shock now in terms of that paring back a little bit. We're seeing some sort of not very optimistic economic numbers coming out of both the U.S., out of China. We're seeing refinery throughput demand in China start to tail off a little bit. So those are sort of scary signs going forward. I think another interesting thing, we just saw Iran lower their OSP, their official selling price to Asia for October on their crude oil barrels by about $1 a barrel. So that is a very sort of pessimistic short-term picture of where some of these producers think demand is going. So it's interesting, and it's very difficult at this point to even predict with any sort of certainty, not just where we're going to be a year or two from now, but even just a couple weeks from now.
Yeah, I think that honestly, looking at demand side, in the short term, I can guarantee you that it's been happening. It's been happening a short term like shift in how people go to work, and whether like, let me give you my personal example. For example, I used to work in downtown, but now I'm doing it from my home, like, which is miles away. So I think that there are a lot of people like me out there, which obviously are consuming less gasoline. But I think that gasoline and other products, depending on the type of vehicle that you're driving. But honestly, I think that we should talk about not only on the physical side, but as the topic of our conversation in risk management, I think that I would like to ask you, Jonathan, do you think that after COVID, the way that companies are looking to their risk management strategies changed, or are they doing the same, or what do you see in this?
Sure. It's interesting. Just to sort of circle back a little bit, one of the things you mentioned was gasoline. Gasoline demand has actually been relatively strong lately, even with the sort of the hurricanes in the Gulf of Mexico really hitting production, really hitting refineries as well. Some refineries have actually come online relatively quickly and sort of surprised the producer side of the market in terms of what their demand has been. We're seeing demand from refineries come as far as looking at Russian barrels. So we're seeing Mediterranean Urals crude, which had been trading at about a $2 discount to forward dated Brent. It sort of rallied to about only about a minus $1 to forward dated Brent. So the gasoline demand has surprised actually a bit to the upside and has been relatively strong going forward. Now, to get to your question about risk management and how that's being approached right now, like I said, there's certainly been a paradigm shift in terms of looking at risk management holistically and taking into account maybe some variables that we hadn't really discussed all that much in the past. I think in terms of what's expected going forward in terms of supply and demand, and what's expected in terms of hedging volumes and risk management, there's been obviously a lot less air travel. So the airlines, there's a bit of a pause going on in the cruise industry, in shipping to an extent. Depends on what you're shipping. If it's a cruise line, then certainly. But on the cargo side of both airlines and shipping, there's been strong demand out there. So there's certainly been hedging from that perspective. But what are they doing? What are they hedging? Obviously, I think in these times of uncertainty, there's a surprising low level of volatility in the crude oil market right now and in the products market. But along with that low level of volatility, there's also a lot of uncertainty. So it'd be very easily for that volatility to sort of explode and the market to move very, very quickly in either direction, honestly, depending on supply and demand factors. One way that is very popular, it's always been very popular, and I expect it to continue, is sort of the costless collar strategy, where a consumer buys upside protection and they pay for that protection by selling the downside put options. Now, what's interesting about moving forward is we're starting to see U.S. tight oil really start to tick up. I think shale oil production this month is expected to be around 8.1 million barrels per day in September, which is about the highest it's been in about a year and a half. So what you're going to see as more of this marginal production hits the market, those marginal barrels are going to be hedged as well. So what's going to happen is, how do producers hedge? the opposite of the way maybe a lot of consumers hedge. They'll do producer collars where they buy puts, they buy downside protection, and they pay for that by selling upside. And a lot of times these producers enter the market with relatively large volumes. So what that can do to the market is actually cause the downside protection, those puts on the downside to rally, and it basically causes a bit of a skew, an upside skew in the cost of that protection. They pay for that by selling upside calls. Now, the flip side of that equation is what the airlines do and what a lot of shipping companies, the consumer side, does. And as more of those producer volumes enter the market, hopefully we also see a recovery in demand and the world returning more to pre-COVID levels, hopefully economically. And the consumer side can benefit from that consumer hedging, from that producer hedging rather, because they can then sell put options further away on the skew because the producers have bid up the cost of that protection. And then they can also buy calls that are closer to where they really want their protection to be relative to their budget. So it's really sort of a symbiotic relationship that when the producers enter the market to hedge, it actually has a very beneficial impact on the consumer side of the market.
Yeah, John, I think that a great topic that you talked about was the fact that the United States production could eventually start to take up higher, which is already doing. I think that obviously we had the Hurricane Ida, which was obviously a short-term noise, but the trend is slowly going up. So I think that looking at to 2022, like we have talks on OPEC really bringing output back. We see the United States, and we are likely to see even Norway, Guyana, and Brazil adding more barrels to the market in 2022. And honestly, when we look at demand, globally speaking, not only in the United States, we're seeing it moving relatively sideways. So I think that there are a lot of downside risks going ahead, mainly throughout 2022, as as major energy agencies are expecting to have an oversupplied market. So I think that do you see this as a downside risk? And if so, what companies can do to mitigate this risk?
Sure, there certainly is a significant amount of downside risk, and I think it's being overlooked at the moment. The oil derivatives market, the forward curve, especially the front couple months, certainly moves very much on perceptions. There's a bit of a herd mentality, and what you're seeing right now, the rally that's been going on sort of in the first couple of weeks of September of this year is basically just coming down to the expectation was that we would be coming out of COVID and that demand would overwhelm supply, at least in the short term. I think there were concerns about Delta, but the Delta version of the coronavirus, but at the same time, you have these storms in the Gulf of Mexico. And I think that was really all sort of the bullish sort of side of the market the speculators really needed to get into the market to sort of drive it up, 5-10%, at least in the very short term. But if you look at the forward curve, you can see that crude oil is very much backwardated. And what that tells us is that as you go further out to Q4, Q1, Q2 of next year, the expectation is that OPEC, with its increasing of 400,000 barrels per day, month on month, to continue into the end of the year and into Q1, that as long as that continues, there are enough barrels to meet demand right now. There's enough barrels to meet demand for the next 6 months to a year, regardless of if we come out of Delta and we start to see more demand globally. So the rally that we're seeing right now, the expectation is that this is sort of just a herd mentality rally. There's plenty of barrels out there. There's plenty of production out there. Production is ramping up, as we're seeing. And behind the scenes, there's some economic data that is really not all that positive. So in terms of dealing with sort of that downside risk, which is certainly out there, all the headlines talk about oil going to $80 or $100. There's a lot of downside risk potential. I think the way to really handle that is there are consumer strategies such as costless three-ways, where a consumer can buy an upside call, and instead of paying for that by selling downside protection, they could sell a downside put spread. So there's only a limited amount of loss on the downside if we have a very significant drop. Conversely, I think on the producer side, they're going to be very anxious to sort of lock in these higher levels, especially if we continue to rally for the next couple of days or even weeks leading into October. If there's more storms in the Gulf of Mexico and we see $80, $85 Brent. I think you'll see a lot of producer hedges. And again, like I said, that is advantageous for the consumers to come in, take advantage of the rally in the put skew to sell that and buy more upside protection.
Yeah, I think that, Jonathan, I think that S&D is obviously something to watch going forward, but we also have to start monitoring the monetary front. Like the Fed is talking about the possibility of tapering, which theoretically would support the dollar index and therefore put a lid in the rally. So I think that there's a lot of variables for us to keep watching, and hopefully we can talk about them in our next conversation. So thank you, Jonathan. It was a pleasure to talk to you. Hope everyone liked the call, and bye.
You're welcome. Thanks, Heitor. Talk to you later.